Good evening, everyone. On behalf of ICICI Prudential Mutual Fund, I welcome you all for the annual Outlook Call 2024. And in this call, we would like to cover our views for the year 2024 on the equity and fixed income markets. And we have also released a communication around our annual Outlook 2024. Post the call, you can refer to that note also for your further understanding of that. So, for today's call, the structure would be like this. We'll start with our view on equity markets, and that would be presented by our panelist, uh, S. Naren, ED and CIO, ICICI Prudential Mutual Fund. And post Naren, there would be a view outlook on the fixed income space by our CIO Fixed Income, Mr. Manish Banthia. And once we are through with the equity and fixed income outlooks, we would move into the Q&A session. That's how the overall structure of this call would be. So again, thank you all for logging in. Without taking much of a time, I would welcome S. Naren for his opening remarks and his view on equity market. Naren, over to you. Thank you.
Wishing everyone a very happy, healthy, and prosperous 2024. 2023 turned out to be a very a good year for the markets. I mean, honestly, we didn't expect such a good year because there were a lot of clouds on the horizon, and we were expecting a volatile year, and we were very confident that multi-asset investing would work. While multi-asset investing worked in a very, very significant way, but we did not believe that small and mid caps would do so well as it did in 2023. The beauty of markets is that very often markets tend to do sometimes very, very well, and there are times when it does badly. And India has had a paradigm shift, over the years, and we've had the advantage of managing other people's money for decades. India has really seen a situation where India has really arrived in the global stage, whether it is through G20 or in any other way, because India is one of the countries over the last decade where we have had a extremely strong macro that the current account deficit, fiscal deficit, inflation, everything has been very, very stable. We have had fantastic political continuity, and we have had strong reforms, whether it is GST, RERA. And if you think, for example, the way digitization has happened and how well, for example, you can do digital transactions on the online side through UPI and various things, it has been a great decade for India. And geopolitically, also, India is one of the few countries which everyone loves to be a friend of. And that has been a big advantage for India in a global context. Due to this, we have had a situation where domestic demand has been good, and we are today, most of the Fortune 500 companies have set up global centers here from which they do various things, whether it is software, whether it is operations and technology, and various other things at this point of time. So that has been an advantage. Having seen markets for a long period of time in our company and managing money across various bull markets and bear markets, there are a lot of lessons we have learned over a period of time. So yes, today India's macros looks very good, but valuations are not cheap. So we went and looked at how the markets have behaved over a period of time over the last 25 years that we have managed other people's money. And we have found that the biggest mistakes have been made by people in big bull markets, whether it is a year like 1999 or a year like 2007. These are the years when market valuations was expensive and everything was looking good. And the kind of mistakes that people have made in those years was actually not practicing asset allocation And those are the years where valuations were not cheap and people actually focused on specific sectors. For example, technology in 1999 and 2007, it was infrastructure. So what this means is that when you have big bull markets like what we have had today from 2020 to 24, there is a case to be actually much more careful. And actually, the times to be very, very not careful are actually in big bear markets, whether it is the period after Lemon or in 2008 or during COVID in 2020. Those are the periods where you can actually be very, very aggressive. And whereas periods like 2007, periods like 2024, these are the periods where one has to be much more careful. What do you mean by being careful? We believe that an investment in approach through asset allocation, which means investing in hybrid categories and multi-asset kind of categories, is actually the best way forward. Because when we looked at all the bull markets that have been in India in the last 30 years, whether it is 1992, Arshad Mehta, whether it is 1994, the first year where foreigners came in, which was the most broad stock market boom, just like the current boom, 1999 or 2007, the best decision would have been asset allocation, which means invest in hybrid kind of products and ensure that you invest in everything, whether it is in equity, debt, and gold, which is what a multi asset kind of category actually does at this point of time. So we think that while everything is good at this point of time, the time calls for more careful investing. Does it mean that the near term outlook is bad? Certainly not. We think that the near term outlook looks good, but investing at a time when valuations are high actually is a period where you have to be more careful. And that is what we are trying to tell to investors very clearly through all our communications at this point of time. Is there a fundamental problem in the Indian economy? Certainly not, because the Indian macro has been managed very, very well. Is there any bubble in Indian equity? Answer is no. While small and mid caps are overvalued relative to large caps, we don't see any bubble in Indian equity at this point of time. Is the corporate earnings reasonable? The answer is yes, they are reasonable at this point of time. So I would say that we believe that there are two ways in which we look at. One is people who have actually invested with us over the years. And we look at people who are going to invest fresh savings. We believe that the people who have already invested with us over the years, I think there is a case to stay invested. Because if you look at it, India is a structural long-term story. And people who have invested with us through the years, whether it is the entire decade, they have actually chosen good times to actually invest. For example, the people who invested with us, whether it is in FlexiCap NFO or business cycle invest NFO or transportation NFO or PSU NFO or a housing NFO. In all these NFOs, people who have invested in that period actually they have got good returns. So I believe there is a case at this point of time for all the people who have invested with us in the past to stay invested. Because one of the experiences which we have seen is that, the old monies actually who have stayed with us over the long term have actually been good investor who made good money. And, one of the biggest investment gurus of the entire life that I have lived in is Charlie Munger. And he has always said that you have to give time to your investments. If you give time to your investments, it turns out to be very good. And one of the biggest he actually passed away last year, and the biggest learning from him has been that give time to your old investments. And I would believe that staying with those old investments is a good strategy. On the other hand, I would say that if you're making new investments at this point of time, there is a case to be careful, because you're not investing at the bottom of the market. You're investing at the all-time high. Small cap and mid cap are certainly much more overvalued. and large cap is more reasonable, but there is a case to be doing asset allocation, which means you either invest in hybrid or you invest in debt and in equity and in gold. So you can follow a multi-asset model and choose one scheme, or you can choose to invest in equity, debt, and gold. And my colleague Manish Banthia will actually talk about debt after I speak. So that is the model we would recommend, because investing purely in equity at this point of time is something which has its own risk, because you're not investing when the market is cheap. You're investing actually when the market is fully valued, or in certain cases overvalued at this point of time. So we would like to make a clear distinction between old monies invested with us over the years and new monies that you're looking to invest at this point of time. And that is how we believe in at this point of time. And clearly, what we have seen from the data is that, if you look at 2023, small cap and mid cap have outperformed large cap substantially. And clearly, we believe that there is a clear case at this point of time that large cap or flexi cap kind of mandates are clearly in a better situation, because those sectors have clearly done much worse than small cap and mid cap. One of the learnings for us over the years is actually to choose themes and areas which have done badly, because we have been a big believer in mean reversion over the period. And that framework we have seen actually works over a long period of time. And that is the reason why we believe much more in categories like large cap and in flexi cap kind of categories, whether it is strategies like flexi cap itself, or it could be strategies which can pursue flexi cap investing, whether it is business cycle, Bharat consumption, value discovery, India opportunities, or any of these things. And we always believe some of the larger schemes are actually much more suited to systematic investing. And that's how we look at it at this point of time. So overall, one of people ask us what can bring the markets down. And frankly, we knew we would tell you, because one of the lessons we have seen from the past is that, did we specifically predict COVID? The answer is no. Could we predict the global financial crisis? The answer is no, in the year 2008. So what happens is there are events which lead to market corrections, but it is very, very rare that it is possible for any of us to correctly predict what brings the markets down. About 3 years back, there used to be quality strategies which actually used to do very well. So people at that point of time used to tell us, that quality stocks are the only ones which can do well. And we used to believe at that point of time that select PSUs, select value stocks, uh, sectors like power, telecom, all these metals, all these sectors were much, much cheaper than some of the quality oriented sectors at that point of time. And people used to ask us, what will change it? Because always quality is quality. They will never do badly. But the last 3 years has seen that many of these so-called non-quality sectors have actually done extremely better than the quality sectors. Like that today, our people ask us, why won't you always make too much money in equity compared to debt? We tell them no. If we knew, we'll be happy. But always there is something called a cycle. And therefore, it is always safer to follow asset allocation or hybrid investing, because it is tough to actually correctly predict what can bring markets down. As you know, for example, one of the biggest growth markets at one point of time was China. And people used to say that, there is no market better than China. But if you look at today, the record of China over the last 5 years or 10 years or 1 year, China has become the worst performing markets. Could we have predicted that 10 years back? Could we have predicted that 5 years back? The answer is no. So what our investment gurus say is very clear. Practice asset allocation, then you don't need to worry. Practice hybrid investing, you don't need to worry. And this is the learnings that we have had over the years, because that is how we believe that we can give investors a good experience at all-time high. So this is broadly. As far as our funds are concerned, we always believe that we should follow the right processes in each fund, whether it is the blue chip fund or whether it is the value discovery fund or any of the, whether it is the equity and debt fund or whether it is the balanced advantage fund, or whether it is the flexi cap fund, we try to follow the right processes. And at times, these processes lead to short term underperformance. And there are times when it leads to good long term performance. So our goal is to follow the right processes. And at times, the processes can still lead to bad short term performance, but we will follow the right processes because that is the goal that we have set, that we have to continuously follow the right processes. And as we manage more and more money, or other people's money, we have to improve our processes. It is just like, if you are doing a pole vault, after you succeed at a certain height, you take the height higher and you have to succeed at that higher height. And that is a kind of way in which we have to keep on improving our processes. So we manage other people's money, more and more other people's money better way. Is it always a one-way ticket? No. At times we can fail, but we continuously make an attempt to improve our processes. That is the reason, we always do not emerge as cheerleaders for the market. At the same time, when setbacks happen in the market like 2020, we do tell people this is the best time to invest in equity. Whereas at times like today, when the markets are at all-time high, we try to tell people, be more careful, because that's the right approach we believe for long-term investing at this point of time, regardless of what happens to the market in the near term. So I'm happy to now hand it over to my colleague Manish. We believe debt is a neglected asset class at this point of time. And we think that the opportunities in debt over the next 3 to 5 years are also going to be interesting. The mutual fund architecture for debt is very good. And we believe that the opportunities in debt are equally interesting for investors. Although in recent times, debt has not been a vehicle where retail investors have been focused on. So over to Manish Banthia, my colleague and CIO of debt. Thank you.
Thank you, Naren, and very good evening to all of you, and also wish all of you a very happy and a prosperous new year. So, as Naren has kind of contextually, said that asset allocation is what is required at this point of time. So, let me take that opportunity to talk about the fixed income markets. Last year, when we came out with this annual outlook, we said that interest rates in India will remain, in the neutral zone. RBI need not hike interest rates or cut interest rates, as we move ahead, in the economic cycle. And 2023 broadly, came out as a year where RBI did not change interest rates at all. The last hike which was done was in February of 2023, and after that, we've been in a state of interest rate, constant neutrality. Uh, and this is important to understand because there were a lot of inhibitions back then, that interest rates in India have been hiked too much. They are very high, and that would lead to a growth slowdown. Especially people who borrow on the mortgage side, buying a house. If interest rates go up too much, it becomes very difficult for people to make payments for their mortgages, and therefore, there will be a slowdown in, mortgage. All of that was being talked last year. It is very important to understand that an economy which is doing well, and when interest rates are at a level which neither are pushing the economy too much or pulling it down, which means that you are not neither restricting the economy or stimulating the economy. The central bank is very happy with that state, and India has been in that state where we've not seen inflation either move up too much or go down too much, and therefore it's a very comfortable macro position where India is. That was the year 2023, and beginning of 2024 again, what I've been hearing overall is the rhetoric that there is a possibility of interest rate cuts, and therefore you should use that opportunity on your portfolios. Let me take a step back and explain you in terms of the broad context where interest rates are in India. I will draw parallel to the real estate market, because it's a market which is easy to understand and relate to for all of us. And if you go back in 2003, that was a time when the real estate market bottomed, and from there the real estate activity picked up. And through those 2003 to 2012, through those 9 years, we saw that the real estate activity went on very well. But for that year in between 2008-9, because of the global financial crisis, we had a brief slowdown, and then it picked up well again. If you compare that with the Indian interest rate cycle, the Indian interest rate cycle also behaved in line with that real estate cycle. From a bottom of interest rates in 2003, interest rates gradually started moving up. And between 2006-7, where the economy was broadly, doing well, the RBI initially, did not change interest rates. They took interest rates to around similar levels of around 7% at that point of time, and then there was a long pause on interest rates. Only during GFC was RBI required to cut interest rates, but that was again short-lived, because 2009-10 onwards they again started to lift that up. So broadly, when the economy is doing well, the Reserve Bank of India does not need to change interest rates, or rather cut interest rates. I can draw that parallel even to equity markets, or rather the earning cycle of the corporates. Again, between 2003 and 2007, we saw an expansion of EPS growth for the corporate sector. And at that point of time, the Reserve Bank of India was concerned that it should not lead to a heated economy. And therefore, Dr. Y.V. Reddy, who was the governor at that point of time, he kind of tightened monetary policy through both liquidity tightening and through interest rate hikes. If I compare that from in the current context, again from 2020 we've seen that real estate cycle has started to move up, and we've seen a strong real estate cycle in the last 2-3 years. Also, from an equity market perspective, we've seen that the EPS growth of corporates have been quite strong in the last 2-3 years. So all of this indicates that the economic cycle is strong, and therefore for the Reserve Bank of India at this point of time, it is important that he maintains the equilibrium. Only in the period between 2013 and 2020, where the entire real estate cycle was slowing down, and the corporate EPS cycle was also very, very slow, was a period where RBI was required to support the economy, and therefore we saw a series of rate cuts in India between 2013 and 2020. Why I'm saying all of this? Because in case of fixed income, and also in terms of asset allocation, it is very important to understand how you allocate your money. As Naren said, that the valuation of the equity market is very important to look at, because it kind of tells you how much is already discounted in terms of prices. So last year, when taxation on fixed income changed, it effectively meant that a lot of money would actually flow to equity. And what it meant also was that because equity had an advantageous position as far as taxation, a lot of returns would get upfronted, because the money would chase equity as an asset. And that is what we've seen in the entire year 2023. Now, if I compare that from where the debt yields are, I think the short-term debt yields right now are very attractive. When I look at the corporate bonds which trade in the 2-year, 3-year bucket, they trade close to 780 or 8% roundabout. At about that level, I think, given that a lot of upfronting has been done by equity, and also given that if I adjust for taxation, I still think that from a cycle perspective, fixed income is a very attractive asset class from an investor's perspective. Now, let me, kind of, draw a parallel to when you look at fixed income. How do you, look at, the various products, and given that taxation has changed, how do you invest in fixed income? Because that's a question which everybody's been asking through 2023. I have a simple framework for that. In my framework, I would choose funds where I would invest for a very, very long period of time, because when I do that, I defer my taxation. If I invest for a very short period of time, my incidence of taxation is very early. So, for example, if I invest for 6 months or a year's time, I'll have to pay tax when I, remove that money. But if I continue to invest for a very long period of time, say 10 years, 20 years, or, till my retirement in a fund, my incidence of taxation is deferred, and when that is deferred, my effective taxation reduces to a significant level. So I would choose products to invest where the products are very actively managed, and the products have the ability to generate returns over its various economic cycles. So therefore, from that perspective, I like products like All Seasons Bond Fund. It is one of the most actively managed bond fund in our entire product category. Uh, I like credit risk fund. And the third is the short term plan, where if somebody wants a lower, risk and relatively is okay with that, then that is another fund which one can choose to invest for a long period of time. I've seen investors who have invested in some of these funds for long periods of time, and the kind of return it generates on basis of compounding. Um, while equity markets near-term returns look very attractive, there have been periods where fixed income has generated much better returns than equity markets. Clearly, from a cycle perspective, as I said, between 2013 and 2020 was a cycle of low EPS growth. It was a cycle where real estate, kind of was struggling. Fixed income outperformed, real estate as an asset class. In a lot of ways, in different periods, it outperformed equity as an asset class. I'm not saying that the economy is going to slow down, but given that the equity valuations are so rich, a lot of your risks which we don't know can come, that has not been discounted in equity markets, and therefore from that perspective, if one wants to allocate portfolios to de-risk themselves, I think fixed income is a very good asset class. And I think within the fixed income, the duration or the long duration part, I think is still tactical. I think the India is growing well, and I don't see RBI, too much room for RBI to tweak interest rates, and therefore one should look for higher carry in products they are investing in, because that will generate most of the returns for the investors. So therefore, I like the short duration assets, specifically something which is in the 1 to 3 year category, which includes product like credit risk fund or a short-term plan, and even the all-season bond fund. Our valuation models in fixed income are still flagging that we should be in the in the shorter duration buckets, rather than changing our position to high duration. I think high duration is tactical, and we would continue to trade it in a more tactical way. But from your allocation point of view, it is good that you allocate your money to products which have higher YTMs and which have the ability to actively manage duration. Um to end this conversation from my side, I would again ask you to reflect on your asset allocation, and I think that from a overall perspective, the short term fixed income looks very attractive as an asset class right now. I don't think that the Reserve Bank of India would tweak interest rates too much in 2024. That's right now the assessment. That can change as we move ahead. And thirdly, from a overall return perspective, while real estate is doing well, equity is doing well, fixed income is also an attractive, asset to allocate at this juncture. I'll stop here, and Manish R, you can open the forum for question and answers. Thank you.
Sure. Thank you, Manish. Thank you, Naren, for your remarks on equity and fixed income market. I'll open the forum for question and answers. Uh, Naren, we have already got few questions, so I'm starting the first question, and that's to you. It's on Naren, your learnings from year 2023, and what are your hits and what are things which you want to do differently, or you want to put it misses for your 2023, Naren?
The clear miss was I don't think predicted this kind of boom in small cap and mid cap. clearly that was a miss, if you ask me. I think the clear hit was, basically not, it was not a 2023 hit. It was a 2020 hit actually. In 2020, we recognized that PSUs, telecom, these kind of sectors were very good long-term auto. These were all good long-term sectors to bet on, and quality stocks were overvalued in 2020 compared to this set of stocks. And when we took that bet in 2020 or 2019, I would say, people used to tell us that this kind of thing will not work because quality will keep outperforming. And in 2020, we went through a 3 to 6 month period where people used to question us every month as to why you have this power PSU. Don't you think power PSUs will not work? And the redeeming feature happened in 2023, and it was not an ordinary hit, it was an extraordinary hit when we got some of the returns in some of the PSUs in power, upstream oil, etc. And the lesson learned was too simple for us actually. And the similar lesson, for example, my colleague Manish and the fixed income team had in a product called floating rate bonds. See, basically investing, if it doesn't make, if you still don't make money after 1 month and it makes logical sense, you have to buy more. And if you don't make money after 2 months, you buy more. And you should be conscious of the fact that you're managing other people's money and you're not entitled to create losses for, you're not entitled to do stupid things with other people's money. I won't say losses because losses can happen in equity anytime. But the fact is that you have to do the right things with other people's money, and then you have to keep doing it on a consistent basis based on a sensible process. When the returns will come is not in your hand. For example, most of the correct decisions were taken in 2020, and best returns came in 2022 and 23. 2020, every day we were questioned, but the returns came in 2022, 23. And that is the beauty of investing, that you have to continuously take logical, rational decisions based on a sensible process, and you will get returns in the future.
Thank you, Naren. Naren, there is one more question, and this is pertaining to the massive inflows which we are seeing from the domestic side. And person has quoted also the huge SIP book which the mutual fund is running. So does it seems like that if there is a 5% kind of a correction or a 7% kind of a correction, the equity markets can turn back very fast? Gone all those days when we used to see a very long correction. As a investor, we have not seen a very long correction period. Is it something to do with the domestic interest or the mutual fund SIP book? Your views on the same, right?
See, we are big believers in fundamental valuation based long term investing. And beyond a point, no, flows don't work in the long run. And when I tell this to everyone, people don't accept my view. In 2011, 12, 13, I have spent a lot of time trying to tell people that real estate was a overvalued asset class. So people used to tell me India's population is keeping on increasing. How can real estate ever not do well? But the fact is that didn't do well because it became overvalued. So I think it is important for us not to get into this mode of saying that you have so much SIP books, so markets will keep on going up. In fact, we believe that flows determine short-term returns. It doesn't determine long-term returns. And when you have extreme overvaluation of any asset class, that causes problem in the long run. And that is why we don't believe in a flows argument. We believe much more in asset allocation as a framework than flows as a framework. And if we had believed in only flows as a framework, we could have never bought PSU stocks in 2020, because at that point of time, there was no flow in PSU stocks. We couldn't have bought metal stocks in 2020. And so you should not, flows is a short-term argument, valuations and fundamentals are long-term arguments. And we are managing other people's money for the long term. And therefore, we believe in valuations and fundamentals as a method of investing. And that's why we believe in asset allocation as the best model, and hybrid investing, like categories like equity saving, balanced advantage, equity and debt, balanced and multi-asset as one of the best ways for long-term investing, because we think that asset allocation is one of the best frameworks for long-term investing. It is not focused on flows, it is focused on valuations and fundamentals. And that's how we look at it.
Got it. Manish, next question is for you, and person is asking, Manish, since you manage hybrid schemes debt portion also, so how is your approach different while managing hybrid schemes compared to a pure debt schemes?
Thanks for that question. And I think, a good question for me to address at this juncture, given that hybrid is something which everybody is looking forward to. Our approach to hybrid is again basis margins of safety, and the entire way in which we have approached this asset class is that we want to generate returns out of fixed income. Our approach in hybrid is that fixed income should contribute to a large extent to returns, and it's not something which is an equity and cash kind of an asset. It's an equity plus fixed income as an asset, so fixed income should contribute to returns. And the way we approach fixed income is that we've been, very opportunistic in taking, positions at different points of time. So I'll just give you some of, the history of how we've invested. Back in 2014, 15, 16, we were very, very positive on interest rates. And, I remember at that point of time, we used to buy 15-year, 30-year bonds in hybrid funds. Post 2018, and particularly after 2020, when one of that event happened, uh, our exposure of double A and single A assets, to hybrid schemes suddenly exponentially increased. And the reason was that we've not seen as high spreads on single A assets or double A assets anytime in our lifetime. And therefore, we thought that it's a great opportunity to invest in some of these assets which are high credit quality, but at the same time they were available at obnoxiously high yields. So we built a very big book on that. 2022 was an opportunity where we took the floating rate bonds in some of our schemes. Again, that was a thought process which came out of this value investing thought of having a large margins of safety. One, we felt that the cycle was right for investing in floating rate bonds, and secondly, the overall spreads which we got in floating rate bonds against every other segment in the fixed income market was absolutely very attractive. I remember also back in 2017, 18, 19, we kind of increased our exposure to additional tier one bonds of banks which were very safe at that point of time, and the spreads at that point of time was very attractive because nobody else wanted to invest in additional tier one bonds. So our approach to investing in hybrid is that unlike some of the other debt funds where we have to look at liquidity, the big differentiator in our hybrid funds is that we've seen that because of our asset allocation strategies, the money which comes is more sticky, and therefore I am not worried about liquidity outflows when I invest in these hybrid funds. So I have a lot of time buffer with me to sit on my investments and ultimately make money, if not in that year, in the next 1 or 2 years. So that's been the broad strategy with which we've managed the debt portion of the hybrid funds.
Thank you, Manish. Thank you. Naren, your view on global markets. Would you recommend global investing at this point of time when most of the central banks, especially US, may be cutting rates in the coming years?
See, the challenge of, I have liked China and I've gone wrong. So I find China a contrarian market which meets my requirement of investing, but I've gone wrong. So I don't know what to say because it's the cheapest market which has delivered. It meets one of my requirements, no returns for 10 years. So if there is a market which gives me no returns for 10 years, I like that market. No, but it's not delivering. Every day it goes down. I don't know what to say. Other markets have done well. And that way, if I look at it, India is a structurally a very good market compared to the other markets which have done well. So I'm not able to come to a conclusion on the other markets. So there are, we do, as you know, we have funds like US Blue Chip and Nasdaq and all that. But the problem is those markets are look fully valued to me. So that's why I'm not able to get myself in earlier periods of time. We would have recommended something like this, but I don't know what to do. Any day seem to prefer asset allocation and hybrid categories like equity and debt and equity savings and multi-asset and balanced advantage at this point of time than investing globally because ex-China, the others all have done well. And China, whenever I've recommended or thought about it, it keeps going down every day. That is where we are.
Sure, Naren. Naren, the next question is, and this is like a more of a introspection when the person is doing. He's saying, ki, honestly, Naren, we hear your view on a monthly basis, and we follow the asset allocation as much as possible. But what happens when we see months like December 2023 or a couple of months like that? It becomes extremely challenging for us to keep the asset allocation as it is, and we kind of bend more towards equity. How do you manage your allocation when you look at people's money and all your learnings on this?
See, the lesson is we don't look at things on a monthly basis. If you look at it, the day you start looking at things on a monthly basis, this problem does come. But we are not used to looking at things on a monthly basis. Frankly, in early December, we did do some TV interviews immediately after the state elections and gave a call that the near term is about large cap. So, and we can't look at it so tactically because finally, at the end of the day, you can look at long term and you'll find that asset allocation works in the long term. Yes, it doesn't work on a monthly basis. So if you are a day trader or a monthly trader, clearly December is a month you should have thrown everything else into the window and done only equity. But we don't think like that because otherwise, what happens is you won't survive the long term. You'll survive months. You'll do very well in months. And one of the lessons, I spent 10 years as a stockbroker. And my learning was that after watching people make too much money, they lost too much money. And after that, I've been here for more than 19 years. And the mutual fund experience is such a pleasurable experience for the customers that through this entire monthly thing, if you look at it, the investors, they may not have made the entire return of December, but look at the kind of returns that investors have made over a period of time. It's such a pleasure experience. Whereas all the people whom when I was a stockbroker, they made a lot of money, but then they subsequently lost most of the money because in periods like 97, 98, 2001, 2, it was all very depressing. Whereas the whole mutual fund model is a very, very good model that has been created by the regulator. The products have also been created well. So that's how I look at it. Otherwise, you can take the most aggressive product and run it. But then finally, at the end of the day, market is not only December 2023. Market is other months as well. And that is our learning.
Thank you, Nani. Manish, your view on commodities like gold and silver. It has done well last year as per your call on multi-asset allocation. What do you see gold and silver has in store for the next coming years? Your view.
So, the call on gold largely last year was because we thought that US interest rates were peaking out. The US, fiscal policy was kind of making the US macroeconomic situation a little, weak. And therefore, best way for an Indian investor to play, a peak US interest rate cycle where, after some time Fed would start cutting interest rates is, through gold, because we do not have access to, invest in US treasuries. And I think the return on gold would, more than make, the return on US treasuries. So that was the call last year, where we said that we're looking at a peak US interest rate cycle in 2023, and it makes a lot of sense to invest in gold. And that call still exists, given the fact that, we've not started to see Fed, cut interest rates. I think till the point we start to see Fed cut interest rates, the positivity on gold will continue. Only when the market starts to price enough rate cuts is where I think gold will kind of mature in terms of its value. As far as other commodities are concerned, especially silver, we think that silver is pretty cheap compared to gold. We kind of measure, the ratio of gold and silver, and from that perspective, silver right now looks relatively cheaper compared to gold, and therefore the expected returns in silver could be, better. Uh, Also, I follow, some of, the business cycles in different economies. And when I look at, the different economies, I clearly see that India is different from US, which is different from China. And to understand that, it is very important to understand where China is at this point of time in its business cycle. China is at its bottom of the business cycle. At some point of time, cyclically, I think China will start to do well. And therefore, I think there will be some floor in terms of commodity prices. And when we've seen that China does well, it reflects on commodity prices. So I think 2024 could be a year. I am, kind of, it's a forecast. I'm not, in the business of making forecasts, but that's the logical, conclusion from my side, that, initially gold will do well. And at some point of time when US rates are low enough, that should kind of, put a floor to commodity prices, and from there commodity prices should start to, do better. I'm particularly, I particularly like copper as a commodity, given the fact that a lot of demand and a lot of future investments are happening where copper is involved. And from a supply side, copper kind of looks as a commodity where you do not have an endless supply. And the efficiency of mining in copper is also going down. So from that perspective, I like copper as a commodity. And some of these calls we've taken in, our product, which is the multi-asset fund, and some of the other products where we invested in gold. And our approach to commodity investing is very active. We kind of look at, some of the broad macro fundamentals, and accordingly, invest in some of these commodities. So therefore, to, put it in short, I think gold looks well initially in the first half, till we see the US rates coming down. And I think, in the latter half, I think commodities will do well. That's a broad thought process I have right now.
Sure. Thank you, Manish. Uh, Naren, you highlighted that 2020 you have made some bold calls, some big hits for you, like especially PSU, power sector, etc., metals, where you have anything which you the person is asking, which you see at this point of time, which is tempting, which is looking good, and where people can invest.
We tell you 3 years from now what we went right here or what we went wrong now, because that is how we look at it. But broadly, there's something we've been telling people, that it's not a bad idea to do systematic withdrawal plan in small cap and mid cap at this point of time. So this is something we've been telling people, and this is something I've conveyed even in my TV interviews. So that's fairly bold call if you ask me, because the most popular thing at this point of time is systematic investment plans there. So for me to say systematic withdrawal plan there is reasonably bold if you ask me at this point of time. So that is one. Other than that, for me, I've been telling people that, when you have had last 10 years of very high returns, my belief has been that the next 10 years will be more moderate returns. And that when I tell people, people are almost up in arms against me. And I think both me and Manish are in the same camp there. But I don't think others are in that camp. I and Manish agree on this. That the last 10 years, small cap, mid cap, all of them have given almost 20% return. And my learning is if you have had 10 years of 20% CAGR, the next 10 years are going to be much more moderated returns. I think that's a pretty bold view I have. And that's one of the reasons why we believe that hybrid is one of the entire hybrid category, whether it is equity saving, balanced advantage, equity and debt, and multi-asset are core products in our opinion. So that's a second bold call. My guru Howard Marks says there are either old investors or bold investors. There are no old bold investors. So when I give these bold calls, I worry whether I should be an old investor, whether I should be a bold investor, because he says there are no old bold investors.
Thank you, Naren. Thank you. Thank you for that. Naren, I think we've covered quite a bit of ground and we're kind of almost coming to the close of call. We've answered quite a bit of questions. So I think it's time for us to close the call. But before that, Naren, your closing remarks for everyone who's listening to this call for year 2024 and for coming years, your view and your closing remarks.
So first, let me again wish you all a very happy, healthy, prosperous 2024. The secret is, I believe, is to let your old investments compound and be careful in new investments. And the best way to be careful in new investments is by following strictly asset allocation in your new investments. And how to follow asset allocation, I think both me and Manish are in the same camp, is by looking at categories like equity saving, balanced advantage, multi-asset, and equity and debt. And don't worry about the market. Continue with whatever job that you're doing and do whatever you can in a larger way. That's how we look at it. We try to manage all your money in the best way possible. Hopefully, we'll do it well. That's our goal, and that's what we are paid to do. And we try to do it as well as we can, because that's what we are supposed to do, and try to do it as well as we can. That's what we are engaged in. Thank you all.
Thank you. Thank you, Naren. Thank you, Manish, for giving your comments on equity and fixed income market. Once again, on behalf of ICICI Prudential Mutual Fund, I thank you all for joining this annual Outlook 2024. Please, we have released the communication note, a presentation on the same. If you want to go through that, it's available on our website and Twitter handles, Insta, LinkedIn. You can look at that. And with this, I'll close the call. Once again, thanks a lot, and you have a good evening. Thank you, everyone. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.